Good afternoon, ladies and gentlemen, and welcome to our weekly 6-minute video series where 6 minutes can make you hundreds of thousands of dollars. This is about the perfect retirement solution for landlords if you own rentals, and how to avoid or minimize the capital gains tax on your personal residence. This week, we're going to be talking about how to avoid the capital gains tax on your rental properties. And we're going to talk about both the pros and cons of that. But first of all, you may know us several different ways, and just want to make sure that you're connected as much as you would like to be. We do have a monthly newsletter that we call the Senior Homeowner Times, and we're happy to send that to you if you'd like. We've also published several books. Best Cities in the West is a book that has listings of the retirement communities in many of the main cities in the Western U.S. Senior Housing Simplified is the overall primer for late life housing transition. Help at Home is a book that we wrote or put together, I should say, from for those people that would like to remain in their homes for as long as it is safe to do so. Don't forget about our website. Lots of great resources there. And to subscribe to any of these books or newsletter, call that number there, 650-758-0319. Our latest book, you can call for a free copy, is called Avoiding the Capital Gains Tax. So we are your one-stop shop when it comes to retiring from real estate and putting all the pieces and experts in place to make sure that you have an ironclad plan for avoiding the tax that will not be challenged by the IRS. We do it all for you, and you pay us nothing extra. Our fees are paid by the top realtors we work with on a shared basis. Legal disclaimer, all of this information is for educational purposes only. Please consult your own experts, professionals, before engaging in these strategies. So why exchange your rentals? Well, I can think of a few good reasons. Number one, you can retire from active property management. In other words, get rid of the 3 T's: tenants, toilets, and turnovers. As we get older, dealing with getting a vacant house ready to rent and finding a new tenant can be a royal pain, and you don't need this anymore. You can totally avoid the capital gains tax of maybe hundreds of thousands of dollars, sometimes over $1 million, and you can double your rental income in the process. I know this all sounds too good to be true, but let's look a little deeper here. So why exchange your rentals? The cons for exchanging your rentals, basically in Bay Area properties, I would say the first one is that your Bay Area property is likely to continue increasing in value, and perhaps at a faster rate than anything that you exchange into. So what will you get in an exchange? Well, many options exist. You can exchange into any investment real estate, such as land or buildings. We recommend institutional grade properties that already have an income producing track record. For example, you can own your own commercial properties like a Starbucks coffee or a Chase Bank or a 7-Eleven store, et cetera, et cetera. Or you can exchange into a REIT with liquidable shares. And many U.S. households already have retirement plans with REITs in them. So how does your income double? Well, the reason your income can double is because it's probably only about half as much as it could be, sometimes even less than that. You could be making $3,000 to $7,000 or more per month on each house that you own. For example, if you own a property that has an equity of, say, $3 million and is renting for about $6,000 a month, after you deduct the property taxes, which I'm estimating here, insurance, property management, property maintenance, you'll wind up with a net rental income of about $4,800 or a 1.92% return on your $3 million equity. If you went into a Starbucks coffee, your income would go from $4,800 a month to $12,500 a month, or from $57,000 a year to $150,000. That's almost triple. Same thing if you exchange into a REIT, a real estate investment trust. About the same thing, $150,000 a year instead of $57,000. And although these do not appreciate typically as quickly and as much as Bay Area properties do, they do appreciate, typically about 10% every 5 years. So don't forget, sometimes you just want to sell your house or you need to sell it. And when you engage us to structure your 1031 exchange into institutional grade properties, you totally avoid the capital gains tax. This tax can be hundreds of thousands of dollars, sometimes $1 million or more. We are your one-stop shop for putting all the pieces and experts together for you. Okay, so next week, special reminder here, every month we host a Zoom presentation that we call the whole enchilada. It's designed to give you a complete overview on all of our strategies for both landlords and homeowners. We show you basically how you can retire from real estate management and headaches, double your rental income, and totally avoid the capital gains tax. This month, the presentation is going to be at 5 o'clock on Tuesday, the 14th. So to register for that, you can go online at seniorhomeownersolutions.com/JAN-CGT or call us at that number there, 650-758-0319. Don't miss our week 10 video. We do these educational videos every week on Wednesday. See you next week. Our topic for next week, week 10, is what is the difference between a DST, a Delaware Statutory Trust, and a REIT, a Real Estate Investment Trust. See you guys either next week on our video series here or at our monthly presentation on Tuesday. Thank you so much for your time.